Now I'm going to tell you about the second strategy. Correct, very good. The premium reduces closer to the date. It's become smaller. That's why here you can see we get $1.20 for 8 days and only 59 cents for 2 days. 1 day before it would be only 30 cents, and on the last day it would be 10 cents and then it's gone. So that's why we sell call option very close to the expiration, maybe 1 week, 2 weeks, 3 weeks, because last week it's the highest expiration. Last 2 weeks, the highest expiration time. Very good question, by the way. Because if you sell for 3 months, first 2 months it wouldn't move, and only during last month it's going to reduce. Did I answer your question? Okay, second strategy. This second strategy, I'm going to tell you that in 2014, Warren Buffett made $12 billion using this strategy. Now, guys, if you think the richest person, at least at some point, richest person in the world is using that strategy, they think, and he is a very risk averse. He doesn't like risks. Do you think it is a good strategy to learn? I know the educational company in Melbourne. They charge for just teaching that strategy, only this strategy, which I'm going to explain, 8,000 Australian dollars for only that specific strategy, because this strategy is very, very profitable. And interesting enough that in this strategy, you even don't have to buy shares. You have to have a security, you have to be able to buy shares, but you don't have to buy shares initially. So the question is like that. Imagine that I'm going to back to a couple slides. Imagine that here we're looking at this particular trend. And we're thinking, the share can continue go to $47 and we can make money on that move, or it has a risk to go down back to this level, right? To 40 or maybe even to $37. So should we buy shares here or we shouldn't? Okay, and that's the question which every trader faces when they looking at the market. Every time, I presume Rick can and William can tell exactly the same. Every time we think, should I buy it here or should I not? Okay, so in this particular case. Now, with put option, can you imagine that if I am more secure about this price, because I can see that it's touched that level, moved up. It's kind of, it's stronger support, so around $40. And I think, I would love to buy it at $40, not 42. Okay, but I cannot buy it. So with put options, what happens? I can create a contract and I give an obligation. I find another person and I tell them, I am happy to buy this specific share at a $40 and you pay money for this, because that person has the shares and that person afraid that that share might go to $35 to $30, etc. That second, the person who sells it doesn't know about this company much, or maybe he's got the company but he wants to buy an insurance in case if something happens, it collapses. So okay, we can have a contract with them, like insurance company contract. If the share price drops down, we would have to oblige to buy it at the price of agreement. Now let's have a look what we have here. So in this particular case, the share price was $45 when I was taking the screenshot. Okay, and look, I could choose $42 strike price or $44 strike price. So lower than, I think that screenshot I was doing in here, in this particular case, 45. But I understand that the share price could go lower here or even here, $44 or $42. So, and I'm happy to buy shares at that price or at that price. Okay, you use only this strategy only when you're happy to have the shares to buy it. Okay, so let's have a look. If I promise that I buy $42 share at $42 share price, that person is going to give me $2.14. So he pays me because I am insuring him. And look at my premium, right, on my profit. So straight away $2. Now, the question is, what's my return on investment? I didn't put a penny in it. My money is still on my account. I didn't buy anything. A lot of people have a struggle to calculate the like return on investment here, because you don't spend a penny, right? So you straight got the money instantly. Now the thing is here that you have to have a secured $42 in Australia, at least. If you don't have margin account, you have to have ability to buy $42. You can have cash, or you have margin on other securities that you can buy it in case if the situation happens like that. So that's why I calculated return from $42. So it gives 5% return. So if you invested $100,000, you would have received $5,000 in 10 days for that particular trade. And if you sold at 44, by the way, interesting thing, important thing here. So that my share price, even though I would buy for $42 if the share dropped, because I received $2.14 as a premium upfront, my break-even cost, my cost of those shares, going to be $39.86. Please put pluses if you understand this part. Can you imagine, instead of buying shares at $45, we can buy them at $39.86 if the situation happens in return? Okay, it's very, very important to understand. That's how Warren Buffett like. It's like buying in wholesale. Okay, you buy it not in retail and wholesale. Other person would buy at $45 and then hope it grows up and sell it higher, right? Warren Buffett sells the put. He waits until a share comes to you. He's not rushing. So we do exactly the same thing. We sold it. If the share price doesn't come to us, it was 45 and moved to 47, that's fine. We got our $5,000 on investment. Okay, so we got 5%. If it went down, which we wanted happen because we wanted to buy the share, that's why we created this contract. Our break-even cost is $39, so we bought it at $39, not $45. This is very good strategy. I love this strategy, and very often I open my positions. Even if I want to buy a stock, very often I buy them through put options. 42 strike. I said 43. Oh, sorry, $42 strike price. I have to change it. Very good point. So I put here 43. It's actually 42. You see, 42 strike price on the left-hand side. It's not 43. So I have to change that. But calculation is correct. So 42 minus 2. So not sure why I left it here 43. Okay, good point. Very good. It means that you're paying attention. That's fantastic. And here it's 44, right? With 44, our break-even would be $41. But if the share price moves up, we get 6.5 thousand, not 5,000. So, and every time you have to make your decision again. Because if you believe that the share price is going to go up at that particular moment, it's much better to sell that put with $44 strike price, because for the same amount of days, you get $6.5 thousand on $100,000 investment. Here's $5,000. So $1,500 more. Okay, you understand that, right? But if the share drops down, in the first case scenario, it would be cheaper for you than here. Okay, guys, put from 0 to 10 how you understand this specific strategy. Again, during the program, educational program, I spend about 2 hours of explaining this strategy in details. When we buy it, what strike prices, why we buy it here, at what volatility we use it, etc., etc. Okay, very good. So if the price drops, for example, the price drops to $35, can it drop to $35? Of course it can. The question is, what kind of companies we're using in this particular case? Same companies which we use for call options. We use this strategy only for quality companies. So the companies which growing in sales, growing in revenue, they're expanding the market, they're developing new products, and also when they're undervalued. We don't sell puts when the company is overpriced. Like, for example, Tesla, let's say Netflix, Microsoft, they're too expensive, Facebook. They're nice, they're fantastic company, they're good quality company, but they're overpriced. They're very pricey. They can drop just because of bad news, they can drop. But when Facebook was 130, 150 last year, then when we were using this strategy, okay? Because the risk of dropping the shares is reduced. And then again, there is a rollover strategy. So what you can do, you can buy it back and roll it again, or you can buy shares and what to do with it. So if you bought shares, how much is the loss when we sell the 42 put and the price drop to 42? There is no loss at all. Because look, you have to buy at 42 and the share price 42. So you can just sell the shares back on the market. If it drops to $39, okay, so you bought the shares, but if you calculate all the money which you received, your cost of that share, $39.86. So you have the shares now. What would you do when you already have the shares? What strategy you can use now? You bought the shares, you already have them. Can you sell calls? I'm going to show you one example in a minute. Okay, let's have a look. That's probably will answer your question. That's what happens. This is Yandex. So the shares here, we don't have shares. We don't buy shares initially. We sell put, but at the end of the contract, you would have to, if the price is going, you would have to buy shares unless you roll it over. There is one strategy when you buy your obligation and you sell the next obligation in the future. So there is not another screenshot to show the another date. But for example, if you take, let's say 17 days, so you probably can buy it at one price and sell it at a higher price. So there is an option like that, but again, so it's more details going to be covered during the education program, and that's what we explained there, how to do it. It's called roll over to the next expiration date. Okay, and I don't know, Rick, do you use it? Do you roll your options to the future? Yeah, it's kind of very popular, but you have to take some things into consideration because sometimes it's cheaper to buy shares and then sell covered calls. You have to. That's the key. That's why I told you, you have to have the ability to buy that share. If you don't have this, it's much better to use other strategies. There would be vertical spreads where you protect your downside. And in this particular, if you have low capital and cannot buy the shares, you have to use another strategy. Not this strategy. This strategy wouldn't be suitable. Okay.